Hi, I'm James Kirby, Managing Editor of Eureka Report, and today in the first of our series, Getting Ready for the Year Ahead, I'm talking to Charles Leyland. He's the Managing Director of Leyland Asset Management. Hi Charles.
Hi James.
Now we're going to talk about shares first of all, and the share market. We're sitting just above that 5,000 mark as I talk to you now on the last day of July. I'm just wondering, when you look ahead and the year ahead for the markets, I don't want to put it to you, where will the market be in 12 months, but tell me, do you feel that it will be the best performing asset class of the asset classes we can allocate from?
Yeah, well, I always say that if someone tells you they know where the market's going to be, they're lying. So, no one's got any idea by the nature of a market-based system. But as far as asset classes go, I think the Australian share market is still very, very good value. It's got a higher yield than both cash and residential property investments, and on a historic basis, on a PE basis, it's trading just below its sort of historic numbers. So, yeah, on a relative basis, I think the equity market's pretty good value at the moment.
So, both on a historical basis and even on an international comparison, are we looking? We're looking like reasonable value.
We are on an international basis, in particular. We see the US market is now at its all-time highs, and we're still sort of, best part of 1,000 points below our pre-GFC
We're nearly
highs.
30%.
Yeah, that's right.
From where we were in 2007. Yeah. Now, but our market in the last 12 months, it was not bad. In fact, it returned 20%. That's all very well, but dragged down substantially by the miners and bolstered hugely by the banks.
That's a very good point.
Now, how do you think that shape will emerge in the year ahead?
Well, the fact that the banks, the nature of our market is that the actual index, when you're only looking at the index, is so closely related to performance of the banks, the large miners and the and News Corp that just because the index was up substantially doesn't mean that everyone made money. There are actually a lot of stocks, as you said, that actually got left behind. So
if you weren't in the banks,
exactly,
you wouldn't really have made certainly the average. Yeah.
No, there was some other good performers, as Flight Centre and Challenger and QBE and a few other good stocks, but basically the rising tide didn't lift all stocks last year. So we're still finding there's still a lot of businesses around, but when you buy a share, you're buying part of a business, and so we still just scour around and look for businesses that we can buy cheaply.
Yeah, so you're not so focused on sectors. But having said that, looking at the next 12 months, will you think our market will still broadly have those characteristics, banks, miners, counterpointing?
Obviously, the miners will be driven a lot by what happens offshore, and that's impossible to predict. We're not buying miners at the moment. We think the risk-return doesn't stack up at the moment, and we're actually cautious on banks because we think Australian residential property is still very, very expensive, and the risk is on the downside there. So we're having to look outside, basically 60–70% of the market cap, and find value elsewhere.
Okay, so you're looking beyond the top 20, are you?
Yeah, yeah. So we're sort of finding value in things like the insurance sector. That seems to be providing some good opportunities at the moment. Other non-bank financial services companies like the Challengers and Flexi Groups and Thorn Groups of the world, they're sort of providing value. So
so almost like going off across the spectrum, moving out from the banks to the next line. Insurers, leasing companies, financial companies.
The media sector's fascinating at the moment. It's obviously been hammered down, and we're value investors, so we want to buy the stocks that have been sort of hammered down, and so you're finding these out of favour sectors like the media sector, which is providing some good opportunities at the moment as well.
You're a brave man, Charles, going into the media sector.
Well, that's how you make your money, I guess, as long as you do your work. You've got to isolate out the general noise and focus on the individual businesses. And within the sector, you always find good and bad businesses, and that's our job is to do the work and sort the wheat from the chaff. One
last thing. The market has been characterised really by a search for yield. Will that be the case in the year ahead? That obsession with yield from the private investors driving the bank prices, etc.
Yeah, it will be, I think, for more your retiree type investors. They still want the yield. To me, the search for yield, unless you actually really desperately need that cash flow, is a bit of a misnomer, because yield is a function of the profits of the company, but more so a function of how much of those profits they decide to pay out to investors. So, two companies earning $10 a share, one pays out $7 and one pays out $3. People have been flocking to the company earning $7. So ironically, probably made the company pay out $3 cheaper. So I prefer to look at total shareholder return when analysing investment than simply the yield, because you can get caught in a yield trap and actually put your capital at risk if you're too focused on yield.
Very good. Thanks, Charles.
Thanks, James.